problem, of course, is that if you have an audience that is yelling, "Swing, you bum," while you're waiting there with a bat on your shoulder time after time, you may get tempted to swing at the wrong pitches. So you have to make sure that you don't psychologically get in the position where you feel you have to swing at pitches that really aren't in your sweet spot.
Did you lose money in the market last year? You're not alone. Even as markets hit record highs, studies show 80% of individual investors underperform the S&P 500. While everyone dreams of financial freedom, most are quietly making the same critical mistakes that keep them from building real wealth. Warren Buffett, who turned $100,000 into over $100 billion, sees these errors repeated generation after generation. Today, I'll reveal the 10 investing mistakes Buffett warns against, mistakes costing you thousands without you even realizing it. By the end of this video, you'll know exactly how to avoid these pitfalls and start investing the Buffett way. Number 1. Timing the market. Warren Buffett has a simple view on market timing. We haven't the faintest idea what the stock market is going to do when it opens on Monday. Yet countless investors obsess over catching the perfect entry and exit points. In 1999, at the height of the dot-com bubble, Buffett warned investors about sky-high valuations while others poured money in. When markets crashed, those market timers lost fortunes. Meanwhile, Buffett was buying quality businesses at reasonable prices, regardless of market conditions. Look at March 2020. As markets plunged 30% during COVID, panic selling swept through Wall Street. Buffett's advice? He told shareholders, never bet against America. Those who sold locked in massive losses, while those who stayed invested saw their portfolios recover completely within a year. Buffett's alternative to timing. Our favorite holding period is forever. Instead of predicting market movements, he focuses on buying great businesses at fair prices. His company Berkshire Hathaway has held Coca-Cola shares since 1988, American Express since 1964, and they've delivered returns far exceeding what any market timer could achieve. The lesson? Stop trying to outsmart the market's short-term movements and start thinking in decades, not days. Number 2. Chasing hot trends. Be fearful when others are greedy, and greedy when others are fearful. This Buffett quote perfectly captures the danger of trend chasing. Remember the cryptocurrency explosion of 2021? Bitcoin shot up 300%, NFTs were selling for millions, and everyone from taxi drivers to grandmothers was offering crypto tips. Buffett's response? He called Bitcoin rat poison squared and refused to participate. When the crypto winter hit in 2022, many investors lost 70 to 90% of their investments. The same happened with AI stocks in 2023. While some companies with solid AI fundamentals thrived, countless others merely added AI to their name and watched their stocks temporarily soar before crashing back to reality. Buffett has systematically avoided the hottest trends of every decade: tech stocks in the 90s, housing in the 2000s, crypto in the 2010s, and yet has outperformed most investors who chase these trends. Why? Because Buffett understands that sustainable wealth comes from businesses with durable competitive advantages, not from whatever's currently trending on social media. Focus on businesses with proven track records, strong balance sheets, and products that will still be relevant decades from now. Number 3. Neglecting fundamentals. Price is what you pay. Value is what you get. This Buffett principle highlights why fundamental analysis is non-negotiable for serious investors. Too many investors buy stocks without understanding basic metrics like price-to-earnings ratio, return on equity, debt-to-equity ratio, free cash flow, profit margins. In 2022, many high-flying tech stocks with negative earnings crashed 70 to 80%, while profitable companies with strong fundamentals weathered the storm much better. Buffett spends hours daily reading annual reports and financial statements. Before investing a single dollar in Coca-Cola, he thoroughly understood its business model, competitive advantages, and financial health. He didn't just like the product. He understood why the company was positioned to succeed financially. You don't need an accounting degree to grasp fundamentals. Ask simple questions. Does this company consistently make money? Is it drowning in debt? Can it weather a recession? Does it have a durable competitive advantage? Buffett's method requires patience and research, but it protects you from buying into financially unsound businesses that eventually collapse. Number 4. Overtrading. The stock market is designed to transfer money from the active to the patient. This Buffett insight explains why excessive trading kills returns. Studies show that the average investor significantly underperforms the market largely due to overtrading. Every transaction incurs costs, taxes, and potential timing mistakes. Buffett's approach? Lethargy bordering on sloth. Berkshire Hathaway makes relatively few investments, but when Buffett buys, he buys big and holds for decades. His turnover rate would bore most traders to tears. In 1994, he explained his philosophy with his famous 20-punch card rule. Imagine you can only make 20 investment decisions in your lifetime. Suddenly, you'd be a lot more careful about each decision. Consider investor Monish Pabrai, who follows Buffett's low-activity approach. By making only a handful of carefully researched investments each year, he's generated returns far exceeding the S&P 500. The lesson? Trading less frequently, but with higher conviction, is likely to produce better results than constantly buying and selling based on short-term news or emotions. Number 5. Ignoring circle of competence. Risk comes from not knowing what you're doing. Buffett's straightforward observation explains why staying within your circle of competence is critical. For decades, Buffett avoided technology stocks because he admitted he didn't understand them well enough. He missed the early growth of companies like Microsoft and Apple, and he was perfectly fine with that. When he finally invested in Apple in 2016, it was because he had come to understand it as a consumer products company with exceptional brand loyalty. Meanwhile, countless investors piled into industries they didn't understand during bubbles like the dot-com era, the 2008 financial crisis, and the 2021 SPAC boom. Define your own circle of competence. Are you in healthcare? You might have insights into medical companies that others miss. Work in software? You might spot promising tech companies before the market fully appreciates them. Just as importantly, recognize what falls outside your circle. Buffett's partner Charlie Munger puts it bluntly, knowing what you don't know is more useful than being brilliant. Never invest in businesses you don't understand, no matter how persuasive the sales pitch or how fast others are making money. Number 6. Emotional decision-making. The most important quality for an investor is temperament, not intellect. This highlights why emotional control determines investing success more than raw intelligence. During market crashes, like Black Monday in 1987, the 2008 financial crisis, or the COVID crash of 2020, Buffett remained remarkably calm. While others panic-sold at the bottom, he was buying quality companies at discount prices. The average investor's emotional cycle is predictable. Euphoria at market tops, the worst time to buy. Despair at market bottoms, the worst time to sell. And constant anxiety during normal fluctuations. These emotions lead to buying high and selling low. Exactly the opposite of successful investing. Buffett combats emotional investing through a rigorous investment framework that doesn't change with market sentiment, focusing on business performance rather than stock price movements, avoiding daily stock price checking, maintaining cash reserves to capitalize on market panics. The solution? Create an investment plan when you're calm and stick to it regardless of market conditions. Automated investing techniques can also help remove emotion from the equation. Number 7. Underestimating compound interest. My wealth has come from a combination of living in America, some lucky genes, and compound interest. Buffett's acknowledgement of compounding's power reveals why patience is the investor's greatest ally. Compounding creates almost magical results over long periods. At age 11, Buffett bought his first stock. By age 30, he was a millionaire. But it's what happened next that's truly remarkable. At age 56, net worth of $1.4 billion. At age 66, net worth of $16.5 billion. At age 86, net worth of $76.5 billion. At age 93, net worth over $100 billion. The vast majority of his wealth came after age 50 through the power of compounding. Most investors sabotage compounding through withdrawing investments too early, failing to reinvest dividends, switching strategies constantly, and not starting early enough. Consider this. If you invest $10,000 at age 25 and never add another penny, at a 10% annual return, you'll have over $450,000 by age 65. Start at 35, and you'll have only $174,000. The early years are critical. Buffett's solution? Start investing as early as possible, reinvest all gains, and give your money decades to grow. Remember his quote, "Someone's sitting in the shade today because someone planted a tree a long time ago." Number 8. Ignoring fees and taxes. Performance comes, performance goes. Fees never falter. This Buffett insight explains why seemingly small costs devastate long-term returns. The average actively managed mutual fund charges about 1% annually. This seems small, but over 30 years, it can reduce your final balance by over 25%. Add in trading costs, advisory fees, and taxes from frequent trading, and the impact is staggering. Buffett demonstrated his conviction on this issue by making a famous $1 million bet that a simple S&P 500 index fund would outperform a collection of hedge funds over 10 years. He won handily, with the index fund returning 125.8% versus the hedge fund's 36.3%. Berkshire Hathaway's structure helps minimize taxes through long holding periods that defer capital gains, reinvesting earnings within the company, and strategic use of insurance float. For individual investors, Buffett recommends low-cost index funds, tax-advantaged accounts like 401(k)s and IRAs, and holding investments long-term to minimize capital gains taxes. Remember, it's not what you earn that matters, but what you keep after fees and taxes. Number 9. Following the crowd. Be greedy when others are fearful and fearful when others are greedy. This contrarian mindset explains why Buffett often moves opposite to market sentiment. Financial media, investment newsletters, and social platforms create a powerful herd mentality. When everyone is bullish or bearish, it creates asset bubbles during optimistic periods, excessive sell-offs during fearful periods, and groupthink that misses obvious opportunities. In late 2008, as banking stocks collapsed and headlines warned of financial apocalypse, Buffett invested $5 billion in Goldman Sachs. The deal included favorable terms that would ultimately net Berkshire billions in profit when the market recovered. Similarly, when oil prices crashed in 2020 and energy stocks were universally hated, Buffett quietly accumulated shares in Occidental Petroleum. As energy rebounded in 2022, these positions delivered massive returns. The lesson? Develop independent thinking. When everyone knows something is a good or bad investment, be skeptical. The crowd is often wrong at market extremes. Number 10. Lack of patience. The stock market is a device for transferring money from the impatient to the patient. This Buffett principle explains why few investors capture the full return potential of their investments. The average holding period for stocks has declined from 8 years in the 1960s to less than 6 months today. Meanwhile, Buffett has held some positions for over 30 years. American Express since 1964, Coca-Cola since 1988, and Wells Fargo from 1989 to 2020. These long-term holdings have been among his most profitable investments. Why? Because truly exceptional businesses compound value for decades, and selling early cuts off this compounding engine. When Buffett bought Coca-Cola in 1988, he saw a company with global growth potential, pricing power, and brand dominance. Many investors would have sold after doubling their money in a few years. Buffett held for decades, reinvested dividends, and turned a $1.3 billion investment into over $25 billion. The solution? Buy businesses so exceptional that you never want to sell them. Focus on companies with durable competitive advantages that can compound earnings for decades, not just quarters. The greatest irony of Warren Buffett's investing philosophy is that his approach is surprisingly simple, yet incredibly difficult for most people to follow. The 10 mistakes we've discussed today are timing the market, chasing hot trends, neglecting fundamentals, overtrading, ignoring your circle of competence, emotional decision-making, underestimating compound interest, ignoring fees and taxes, following the crowd, lack of patience. Avoiding these mistakes doesn't require genius-level intelligence or insider connections. It requires something much rarer, the discipline to stick to a proven strategy when everything around you suggests doing otherwise. As Buffett himself says, the most important investment you can make is in yourself. By learning these lessons and applying them consistently over decades, you can achieve investment results that might seem impossible today. Remember, Buffett didn't become one of the world's richest people through get-rich-quick schemes or market timing. He did it through disciplined application of timeless principles, year after year, decade after decade. Start applying these lessons today, and your future self will thank you. If you found value in this video, hit the like button and subscribe for more investment wisdom. Leave a comment sharing which of these mistakes you've made. We all have. Until next time, invest smarter, not harder.